At this point of the course, you've already learned the 5 asset classes. You've learned how you can invest in them either directly or through an investment vehicle. You've done your risk profiling and understand yourself better as an investor. You've learned the all critical and I would say difficult concept of asset allocation and seen how it works in real life. It may be a good point to pause for a minute and think, to what end is all of this learning? Obviously, to make more money. So the next question is, to what end is all of this money that you plan to make? The answer to that is to achieve all your goals. And that's exactly what we are going to talk about in this session and the next 2 sessions, about how you can set your goals and map all the investments that you plan to make to achieve these goals. Someone has rightly said that when a dream is written down with a date, it becomes a goal. And that is what we are going to talk about in this session as to how you can set and manage your goals. When a goal is broken down into steps, it becomes a plan. And I'm sure by the end of this course, you would have your plan in place. And what is required after that is a plan backed by action is what makes your dreams a reality. With this thought in the back of our mind, let's look at what your goals are. Well, there is no end to an imagination with respect to what can be your goals, but some of the common goals you can think of are a regular holiday you would want to go for and visit the different corners of the world. A goal of higher education is pretty common when you're planning either for yourself or tomorrow for your children. Buying a car is one of the earliest assets a family would own in their financial life. If you are young and independent, it is not uncommon today for you to fund your own marriage rather than having your parents fund your marriage, as was the norm in the past in India. Buying a house is one of the biggest asset purchases you would make in your lifetime. Another goal which each and every one of us would have, whether or not we've written down and thought about it, is to retire. And here we do not talk about retiring meaning not doing any work. Here we talk about retiring financially. While these are some of the pointers you can think of, let's take a pause for a minute and make a list of all the goals that you would have. And when you're writing these goals, make a note of 3 things: what your goal is, in what year you plan to achieve this goal, and how much money you would require for your goal to become a reality. Now that you've made a list of your goals, let me introduce you to the concept of present value and future value of goals. So if one of your top goals is to buy a car for yourself, which is going to cost you 5 lakhs today, and you plan to buy this car 3 years later, do you think the car will cost you the same? Definitely not, right? Because within 3 years, inflation would have resulted the value of your car going up. So if you require 5 lakhs to buy the car today, you would definitely need a higher amount if you want to buy the car 3 years later. So if it costs you 5 lakhs to buy the car today and you plan to buy the car after 3 years, if you assume an inflation rate of 6%, you would need to accumulate an amount of 5.95 lakhs so that you can buy your dream car. So what is happening is the value of the car has increased, but the car itself has not changed. So what has happened is inflation has increased the amount you should set aside, because you're not buying the car today, but you're buying the car 3 years later. Let's then compute the future value of your goals by using our Wealth Cafe investing tool. You will find the tool in the section immediately after this session. You can pause the video, go there, download the tool, open it up on your system, and then we will run through the tool together. If you look at the investing tool, we have mentioned a number of goals for you. You can change this and replace it with the goals that you have, whether it be travel, buying a car or a house, or setting up your dream wedding budget. You need to mention the tenure in terms of how many years later you need the money, and below that mention the amount that you need in today's value. The reason we mention today's value is you can easily look up what is the cost of a particular car today and mention that value here. We assumed an inflation rate, and once you compute that, with a function of the number of years later you need the money, you will arrive at the future value of your goal, which is going to be higher than today's value, because inflation has resulted in increasing the cost of your goal. So if you take up an extremely short-term goal like travel, where you need a lakh of rupees 1 year hence, taking into account an inflation of 6%, you would need to budget a future value of that goal at 1,06,000. Whereas if you take a goal like higher studies, wherein you need the amount 5 years later, you can see that the future value of the goal is much higher at an amount of 40 lakhs plus. In this case, we've assumed the inflation to be 10% because the cost of education has been increasing at a rate which is much higher than the average inflation, which is 6% as prevalent in India. If you have a goal of buying a house wherein you want to set aside 75 lakh rupees today for buying your house, but you don't plan to buy it for another 10 years because you need some time to accumulate money for buying a house, or you have some other more important pressing goals which you would like to meet before you think of buying a house, you can see that an house which you want to buy for 75 lakhs, the cost of the house will continue to increase at a rate of 6% every year, and finally when you actually plan to buy the house 10 years hence, you would need 1.34 crores to be set aside for purchasing that house of yours. It is important to understand this concept because when you set aside an amount today, it is going to be lower, or if you set aside just 75 lakhs and when you actually want to go and buy the house 10 years hence, you will realize that the 75 lakhs is not enough to buy your dream house and you need a higher amount to buy that house. Once you've made a list of all the goals that you have put a date to them in terms of how many years hence you would need that money, and also put an amount against every goal, the next thing you must do is segregate your goals between short-term goals and long-term goals. Short-term goals are all goals which need to be achieved in the next 3 years, whereas anything beyond 3 years can be considered as a long-term goal. So if your vacation and buying your car, which is in the next 3 years, they would be considered as a part of your short-term goal, whereas your higher education, buying your house and retiring would be considered as your long-term goals. So once you've listed down your goals, you are able to segregate them between short-term and long-term. It is important to keep a track of these goals to check when a long-term goal becomes a short-term goal. So if today your higher education is a long-term goal because you plan to go for higher studies in 2025, 2 years hence when you look at your goal chart, this goal which was a long-term goal today will actually become a short-term goal 2 years hence. So this is a check you must do on a yearly basis to be able to segregate between your short-term goals and long-term goals. The reason why this is important is whether your goal is short-term or long-term will actually have an impact on your decision of where you invest your money. All the money that you're earning, putting aside as your savings and investing it for your future requirements is to achieve these goals. And that is why when you have a short-term goal or a goal which is due in the next 2 to 3 years, you would want to put all the money that is required to achieve these short-term goals in low risk, low return products, because in the short term, having the money available to achieve the goals is more important than trying to make quick returns in a short period of time. If you go and look at your 5 asset classes, when you're investing for the short term, you will invest your money in the low risk, low return products, that is cash and debt, and you would not want to risk your money in the high risk, high return products, especially the money that you need for the short term goals. While all the allocation towards short term goals goes into cash and debt as an asset class, all the money that you need for your long term goals is going to be invested as per your risk profile. So if your risk profile is that of a growth investor and you're going to put 30% of your money in debt and 70% in equity, that is where you put all the money that is required for your long-term goals after you've allocated the monies required for your short-term goals into cash and debt. The reason you do this is because you cannot risk your money which is required in the next 2 to 3 years in a high risk, high return asset class, so that you are left with a scenario where you want to withdraw the money today to be able to go to college tomorrow and the markets crash and you just don't have enough money to pay for your college fees. That is why it is important to segregate your goals between short term and long term. All the money that is required for your short term goals, which are due in the next 3 years, gets invested in cash and debt as an asset class, whereas all the money that you require for your long term goals gets invested in a mix of all the 5 asset classes, which is determined by your risk profile of whether you are a growth investor or you are an aggressive investor. By assigning your high risk, high return category of asset classes towards goals that you need for the long term, you will attain 2 major benefits indirectly. Let's look at both of them. When you put aside equities for the long term, you are in a way managing the risk associated with investing in equities. Now it is a given and you understand by now that equities as an asset class is a very risky and a very volatile asset class. If you look at the charts of equity, when the markets crashed in the year 2008, we had seen that irrespective of which equity share you held on, irrespective of how good the company was, the systematic risk associated with investing in equities ensured that everybody's portfolio was a sea of red and you were sitting with huge losses when the markets crashed because of the bankruptcy of Lehman Brothers. Same thing was repeated in March 2020 when equity markets crashed because of COVID pandemic hitting the global markets. And the crash in 2020 was more severe in terms of the fact that we saw a 30% wipeout in less than 4 weeks time, something which was not seen in such a short span of time in the past. While there will always be volatility in equities and there will always be reasons why markets crash, each time trying to justify that by saying this time it is different is something which is very dangerous when you invest in equities. Given that there will always be the risk with equities, the best way you can make money by staying invested in equities is to manage the risk. And one of the best ways to manage the risk of investing in equities is to stay invested for a long period of time. Let me show you some numbers to prove what I am trying to say. If you look at this table that shows the returns that are expected from investing in the Indian equity markets, the data from this table is based on an analysis of the past 29 years of investing in Indian equities in the form of being invested in the BSE Sensex. You will find that if you are invested for any period of 1 year in the last 29 years, if you pick any 1 year, the probability that you will make a loss is 36%. Whereas if you increase your tenure for which you are invested and pick any 5 years out of the last 29 years, the probability that you will make a loss for investing in equities is 13.4%. And the magical period at which point in time the probability of making a loss in equity becomes 0 is when you invest in equities for a period exceeding 12 years. So when you are invested in equities as an asset class for a period exceeding 12 years, the probability that you make a loss becomes 0. So what you've done is, by being invested in equities for a long period of time, you've taken away the risk associated with investing in equities. The day-to-day volatility is always going to be there. The movements in markets are always going to be there. But the probability that you make a loss becomes 0 once you're invested for a period of more than 12 years. If you look at the chart on the right hand side, you will see the range of returns that you expect. If you see, the range keeps reducing as the number of years keeps increasing, from a range of -58 to plus 336% for being invested in 1 year, which exactly showcases the risk that is there, the volatility that you will experience by investing in equities. If you go to the right hand side most side of the chart, you will see that if you're invested for a tenure of 14 years, the range of returns you will expect is from plus 2% to plus 29%. That means the probability that you make a loss by investing in equities has actually become zero. When you invest in equities as an asset class, there is no guarantee of the returns that you can make. The guarantee which is associated with equities is the risk, that is the volatility. That is, it is guaranteed that you will face volatility when you invest in equities, but you can improve your returns, or you can reduce the risk, reduce the chance that you will make a loss by staying invested in equities for a long period of time. While in theory it looks really good that when you stay invested for a long period of time, you minimize the risk or the probability of you making a loss for investing in equities, what do you think happens in reality? For this, if you go back and look at the data of AMFI, which states with respect to an average holding period of investors in equity mutual funds, you find that almost 50% of the investors have invested for a period less than 1 year. And it is only 30% of the investors who are putting their money in equity mutual funds for a period exceeding 2 years. So the data that we see here is very contrary to the basic understanding that you must invest your money in equities for a long period of time. The reason can be that either investors are not patient enough, or investors are getting into equity investments just for the sake of making quick returns, and if they don't see those quick returns, they exit the market and go running for quick returns to some other avenues. Either ways, the reality does not reflect what the long-term wisdom says of staying invested in equities for the long term so that you reduce your risk associated with it. Paul Samuelson had a very interesting quote when he said, "Investing should be like watching paint dry or watching grass grow. If you want excitement, take your money and go to Las Vegas." Right? So the common understanding of long term itself, if you talk to any of your fellow investors, they may talk about long term being maybe 2 years or maybe 3 years, but that is not long term. Based on the numerical data, it is when you have invested for a period of more than 12 years is when you've made the probability of making loss zero. So it is this understanding or the mindset that you have when you invest in equity that needs to change. When you assign equities for your long-term goals, you are indirectly managing the risk associated with investing in equities, and by staying invested for the long term, because that is the money which you need for your long-term goals, you are ensuring that the volatility that your portfolio will experience in the long term is reduced, and you actually make the best of this asset class called equities, where the real wealth creation happens. By putting your money in equities for the long term, not only do you manage the risk associated with investing in equities, you have a second benefit of realizing the power of compounding. Now, what do I mean by this? If you look at the wealth creation chart of Mr. Warren Buffett, you will see that more than 95% of his wealth was created after his age of 66. Warren Buffett is known to have started investing when he was a teenager, but the majority of his wealth creation happened much later in his life after his age of 66. And his portfolio is not of a small amount. He's worth more than 74,800 million USD, of which the major chunk came in the later part of his life. The reason being, that is how compounding works. No matter how talented you are, some things just take time. You cannot produce a baby in 1 month by putting 9 ladies on the job. It will take its 9 months to produce a happy and a healthy baby. Like all our discussions before, let's understand the power of compounding by looking at numbers. We go back to our friends Arjun and Imran to help you understand how the power of compounding works for you. If you take an example of Arjun, who started investing early in his life and started with a monthly investment of 10,000 when he was just 25 years old. He invested this money for the next 30 years till the age of 55. By the time Arjun is 55, over a period of 30 years, he's invested an amount equal to 36 lakhs, which is arrived at 30 years multiplied by 10,000 per month for 12 months of each year. That gives you an investment amount of 36 lakhs. From Arjun, let's move to Imran, who was more of a carefree person, but then at the age of 35 he realized that it's time for me to start investing, and he started investing his money. But since he had only 20 years left till he reached the age of 55, he decided that he wants to match up the amount which Arjun has invested, so that he will invest an amount equal to what Arjun has done, and he decided to put aside 15,000 per month from the age of 35 till the age of 55. So for the next 20 years, he invests 20 multiplied by 15,000 multiplied by 12 months of each year, which gives him an amount of 36 lakhs. So by the time both of 55 years, both have invested 36 lakhs each into equities, and then both of them decide to meet over a cup of tea and discuss as to who has made how much in their respective portfolios. Intuition says that obviously Arjun should have made a higher amount of money because he started investing early, but the question to be asked, and something which you must pay attention to, is how much higher? Both of them invested an amount of 36 lakhs over a period of 30 years for Arjun and 20 years for Imran, and assuming that both of them had invested their entire money in equities and asset class and earned a yearly return of 15%, when both of them retire at the age of 55, Arjun retires with a corpus of 6.92 crores, whereas Imran retires with a corpus of only 2.24 crores. So Arjun earns an amount of money which is 3 times more than what Imran makes, only because Arjun started 10 years earlier. So you can see the power of compounding in action here, wherein Arjun is able to realize a much higher return because he started investing earlier than Imran, and the money started working for him, compounding for him at a rate which was much higher than the rate at which the same money was compounding for Imran. To help you understand this example in a different approach, if I were to ask you that how much should Imran invest so that he ends up with the same corpus that Arjun was investing for. So Arjun retired with a corpus of 6.92 crores. If Imran also had to target a corpus of 6.92 crores when he started investing at the age of 35, how much money should he invest? If you do the number and maths, you will arrive at a number of 46,240 per month. That means Imran will have to put aside 46,240 per month because he is starting 10 years later, so that when Imran retires at the age of 55, he also ends up with the same corpus as Arjun of 6.92 crores. So if you do a comparison, you will see that Arjun put 36 lakhs to achieve the corpus of 6.92 crores, whereas Imran has to invest 1.1 CR so that he can also achieve the same corpus of 6.92 crores. So you can see here that even a delay of just 2 years results in a corpus amount of 5.11 CR, which is 26% lower than the corpus which Arjun achieved was 6.92 CR. So by starting late, you actually have your money work for you late, and the power of compounding results in a smaller corpus for you. So that is the power of compounding for you, wherein starting early and staying invested for a long period of time can have a huge impact on the overall wealth that you retire with when you invest in an asset class like equities, because this is the asset class which gives you the maximum returns when you stay invested in them for a long period of time by starting early. That is why it is said, do not wait to invest, but rather invest your money and then wait. Our key takeaways from this session is we are learning how to manage our money and grow our wealth so that we can achieve our dreams, we can achieve our goals. And once we start on the path of jotting down those goals and we start working towards them, that is the first step that we take. Once you've listed down all your goals, break them up into short-term and long-term goals, so that your short-term goals, you allocate all your debt investments or your low-risk, low-return investments so that money is available when you need it. For all your long-term goals, you invest your money as per your risk profile and allocate your high-risk, high-return investments like equities for your long-term goals. By assigning equities to your long-term goals, not only are you managing the risk associated with equities, which reduces as you increase the tenure for which you stay invested in them, you also start enjoying the power of compounding. Mr. Albert Einstein rightly said, the people who understand the power of compounding enjoy them, and the people who do not understand it, they pay for it. With your goals listed, along with the amounts that you need to achieve the goals, let's move to the next session where we will talk about how you actually invest so that you're able to achieve your goals.